Samarangan Chairman and Managing Member of Great Hill Capital, Thomas Hayes. How are you, Thomas?
I'm doing well, Safrina. Thanks for having me.
It's near Thanksgiving and the good news has been here, you know, the good news that has been waiting for all the markets, especially not only in developed markets, but also developing markets, just like Indonesia. So inflation level fell more than expected to 3.2% in October. And this is the first decline in 4 months, Thomas. You must have something to say about it.
There's no question about it, Safrina. I think what this signals is that the hiking cycle peaked in July, and the Fed moving forward prospectively, they're going to continue to talk hawkish, but remain dovish in their actions, which is the most important thing. They're certainly done, and the question now becomes, how long can they keep rates elevated? I think the answer is probably not as long as they think, but longer than the market thinks. So yesterday was a complete sea change in markets. The odds of a December hike actually collapsed down to 0%. And now the odds of cuts picked up. As a matter of fact, by March of 2024, the market is expecting a 34% chance of the first cut. By May, a 69%, and by June, a 90% chance of the first cut. I think the market may be getting a little bit ahead of itself. We do have a lot of speakers, Fed speakers coming out over the next week, so I'm sure they're going to try to tamp down expectations a little bit.
Yeah.
But the good news all in is the Fed is done.
Okay, now what do you see about this? The data, 3.2%, we have reached this point on July 2023. But now again, if you look back at the historical data over 2023, we have reached 3% on June 2030, and then it spikes again to 3.2, led back again to 3.7. Is it going to happen again? What do you see about this possibility?
Yeah, I think, we got a reprieve from energy. Certainly used cars were down. Shelter at 0.3% is, under 4% annualized. So that was a welcome reprieve. Airline fares were down, but certainly we could see some volatility. We could see some spike ups, but on balance, that has to persist. I think the target of 2% is a nice talking point. It's unrealistic. When you have debt to GDP over 120%, you have to let inflation run a little bit higher than normal, just like we did after World War II when we had debt to GDP of 120%. We ran inflation in the 3, 4, 5% range for a number of years that helped bring debt to GDP down. I think that will be the playbook this time as well. But the Fed will remain vigilant. The Fed will continue to threaten markets with more hikes, but more likely than not have to act on that. I think they'll be doing cuts sooner than they'll be doing any hikes, but the cuts may be further off than the market is pricing at the moment.
Sure, Thomas. And can you talk more about the non-farm payrolls? It reached 150 by this October. Do you have something to say about it?
Well, I think the non-farm payrolls was a welcome reprieve this month. The November numbers plus 99,000 came in much lower than expected. And this is the Goldilocks scenario where you have a little bit of softening in labor, which takes off of the table the idea of a wage price spiral. And this kind of reprieve in the labor market is welcome. You want to see, number one, more people are going back to work. We've had an increase in the labor force participation rate in recent months, which means we have a greater supply of labor as people spend through their excess savings, which helps keep a lid on wages, which takes the fear of accelerating inflation off the table, which puts the Fed at rest and enables them to discontinue the hikes as we've seen since July. So it's really a perfect scenario. Our earnings are growing, our economy is growing, the labor market is cooling a little bit, inflation is coming off the boil. So it's kind of the best of all worlds at the moment.
Okay then. So if you say that the Federal Reserve will hold its interest rate, and if it's going to hold its interest rates, what condition then will make the Fed reduce interest rates in the coming period? As you said before, there's this playbook because relating to the debt ceiling, you got to run the inflation a bit higher than the target in 2%.
Yeah. Yeah, I think there are a couple of things that could force them to do cuts sooner. Well, two things. A spike in the unemployment rate would cause them to cut. They don't want to see massive unemployment because on that basis they would have to do too much stimulus and print too much money to fix it. So they don't want to see unemployment go through the roof. That would cause them to cut if that starts to creep up. I think the other thing that they should be afraid of, and very afraid of, is the possibility of deflation potentially setting in. That would cause them to cut aggressively to try to avoid, because inflation is much easier to control than deflation. Deflation you can be stuck in for many years, as we saw in Japan. So they have to keep an eye on that. And then the last thing that would potentially cause them to cut would be dramatically below trend growth. If you start to see GDP come in well below 2% or even negative, on that basis, they would cut. I think that's a low probability, but I think the number one thing they've got their eye on is the unemployment rate. If that starts to tick up a little bit too aggressively, they'll be cutting sooner than expected.
Sure, Thomas, and let's get straightforward about what is the impact of this inflation rate that is cooling down to 3.2% to Wall Street, Thomas.
Well, I think you saw the beginning of it yesterday. Big rally. You're starting to see, a lot of our gains year to date have been driven by what we call the Magnificent Seven, which is predominantly large cap growth stocks in 2023. What you saw yesterday was a regime change where you had massive breadth in the market. Breadth meaning the other 493 stocks in the S&P 500 were all up. And the key was small caps had one of their best days in a long time. Small caps is largely weighted with regional banks. That index was up over 5%. I think as we move into 2024, what do steady rates and a weaker dollar? We had one of the largest one-day drops in the U.S. dollar, over 1.5% yesterday. What does that mean moving forward? It means two things. Number one, small caps can start to outperform. They've been acting poorly in the recent year. But more than that, what's important for your viewers, Safrina, is emerging markets can start to fly once again. As the dollar comes off the boil, like we saw last fall when the dollar weakened, emerging markets shot up. Then you had this counter trend strength in the dollar. That's now weakening again. We're going to see another rally in emerging markets. So as we look into 2024, I think two areas of outperformance are going to be small caps, particularly small cap value in the U.S. and emerging markets in China. As the dollar weakens, you're going to see more and more flows into emerging markets, and that should be a good thing for your audience.
For Indonesia point of view as an emerging markets, as you said before, we would really want to know, is this already the terminal rate for the Fed? Or the Fed will raise interest rates at least once more? When do you predict this will happen? Under what condition? How do you see it in the future?
Yeah, right now, the odds of a hike, if you look at Fed Fund futures, is 0%. Certainly, there could be a situation where energy reaccelerates. So you have, black swan risks in Gaza if that conflict accelerates, and we saw some more increase in energy, which would cause inflation to somewhat reaccelerate. If it was a sustained higher energy prices, then and only then do I think you'd have the possibility of an additional hike. I think that is a low probability. Furthermore, with the amount of production coming out of the U.S. and coming out of places that are not part of that region, I think even in that case, if you had an acceleration, the odds of a hike would be, the bar is extremely high to do another hike, and I wouldn't bet on it whatsoever. So in that case, dollar weak, emerging market equity strong.
Well, thank you so much for your valuable insights to CNBC Indonesia viewers. We wish you well, and always pleasure to have you in CNBC Indonesia. Thank you, Thomas.
Thank you, Safrina.